Here with me at Post 9 is Liz Young-Thomas, SoFi's head of investment strategy, Joe Terranova of Virtus Investment Partners, and Jack Manley of J.P. Morgan Asset Management. Joe, of course, a CNBC contributor. And Joe, let me just start with you just because of the Alphabet connection here. It's been pretty well timed with where the indexes actually started their afternoon down leg when Google sort of lost the bid there. How would you be thinking about it? Also, in light of everything else we've heard from this week.
They spoiled the afternoon party that potentially we felt like we were going to have. A lot of chatter being traded during the early afternoon about maybe we've exhausted the selling. It was perfect. You know, the S&P fell from the intraday high on July 16th to the intraday low this morning, 4.9%, 9.5% for the NASDAQ. Everything felt right, and it looked like we were setting up for, okay, let's hear what Amazon, what Meta, what Microsoft have to say next week. But then you get the news from Alphabet. And I think, Mike, it speaks towards the Mag 7 are priced for perfection. They're priced for perfection, and any misstep, any stumble is going to be greeted with selling pressure. Immediately what comes to mind for me with Alphabet is, okay, $13 billion? No, we're probably going to have to spend a little bit more than $13 billion to combat a lot of what's going on, and now obviously with Search GBT.
Sure. Liz, the Microsoft and Amazon earnings, that's out into next week. That seems like an eternity in a sense, both because this market is very in the moment, but also we have the PCE report tomorrow. Obviously, the Fed meets next week. We got GDP today. So on the one hand, you could look at what's been going on the last couple of weeks and say, you had a fully valued market, seasonal weakness, maybe overbelief in the soft landing story. It's an obvious time to pull back. But then the question is now, July cut, is the economy weakening even more? So there's always a little bit of a growth scare that gets thrown in. Sure. How are you viewing it?
So, first of all, I'm not in the camp of a July cut. I don't think that Powell wants to surprise markets that way. He doesn't like unnecessary drama, and I think it would cause unnecessary drama at this juncture. I think it would make markets believe that something else was wrong that we didn't know about yet. So I still think September is the first time that they cut. But I do think that we're going to start to hear more dovish language from them at the July meeting at Jackson Hole that will get us to a solid place of what our expectations are for September. I also think that commentary over a 50 basis point cut in September is going to continue heating up. That's still a contrarian view, but I think it continues to heat up. When you look at what's happened in the market, so I was on Closing Bell on July 9th, and I mentioned that forward PE ratios on the S&P were in the 89th percentile. We're still there. Still high, okay? Not above 90, but still high. When you look at the spread between the equal weight S&P and the market cap weight S&P, the one-year return spread was 17% then. It's narrowed to 11%, but we're still in the 95th percentile. So what does that mean? It means the rotation is on slowly, right? But will it last? We've seen this story before. We've had a lot of head fakes with this before. This time, what is different is that we are approaching a cutting cycle. Typically, a cutting cycle is not this huge expansionary signal for the economy, and a yield curve that's uninverting, also not a bullish signal for the economy. So I think what we're going to see is that rotation right now that's happened into financials, into small caps. It can last a little bit longer, but as it conks out, I think we'll see a rotation more into dividend-paying stocks, utilities, staples. Energy, I think, will catch a bid again, and then healthcare.
So kind of... you know, this has been a bit of a staticky message from the market in a sense, because you had this Phoenix Act from small caps and financials in the last couple of weeks. And I keep pointing this out. Usually you see that kind of a rip when the economy's already been weak and you're coming out of, it's like early cycle action in a way, new bull market type action. On the other hand, small caps underperformed vastly in a strongly growing economy up till now. So in other words, there's just a lot of mixed signals about how this market is behaving relative to the underlying economic cycle.
Yeah, I mean, small caps have not been able to get off the mat and make new highs for, I think this is their 6th attempt at doing that. Maybe they do it this time. I think part of what's happening here is because we haven't gotten to the point yet in the AI cycle, Joe mentioned that they're priced for perfection. I think they're priced for profits to be coming in from AI today, and that's just not going to happen yet. We don't have all the use cases. We don't know how margins are going to expand, and now the rubber is hitting the road where investors want the proof. Where is the money going to come from? So some of that impatience that we're seeing, I think there's a rotation just because people don't want to take money out of equities right now. So let's find somewhere else to put it. What's more attractively valued? What still has growth potential? What does well when rates fall? And the answer to most of that is small cap. So that's where we've seen it go. But it can come back out just as quickly if people start to get nervous. And I think the key to that nervousness is whether or not the labor market stays steady.